Daniel LeBeau. Welcome back to the Fourth Revolution. We talk about stocks for your portfolio of the future. Those stocks of the future have been ripping over the last few weeks following the FOMC's actually more hawkish than expected short-term outlook. But when you look a little bit deeper into the projections, you see that their longer-term rate has been declining since the pandemic began, falling another 10 basis points in this latest meeting, showing the Fed is going to be more accommodating in the next the coming years, the next decade of this digital renaissance of innovation that we're going to be seeing, and having that cheap money, going into these financial models, especially from a fundamental standpoint, is allowing that terminal value for these growth stocks to be so much larger. Terminal value for growth stocks is one of the most significant factors when modeling them out compared to more shorter duration companies that have cash flows. Today, these longer duration companies like ARK Innovation, Cathie Wood's ARK Innovation ETF, which is focused on the next 5 to 10 years of returns. These companies have a lot more weight on those future cash flows, and that a 10 basis point cut in the long-term rate is a lot more significant to the valuations of these growth companies than people are giving it credit for. And I think that's a lot of the reason why we're seeing this rally, along with the assumption that we're going to continue to see strong economic demands as inflation continues to roar higher. So let's take a look at what the FOMC did in its latest meeting, in mid-March, and take a look at where these treasuries are trading right now, with an inversion being a big fear among investors. But let's take a look at why that isn't the case. This yield curve inversion that we've been seeing amongst treasuries might actually be a bullish sign for growth if the markets can remain buoyant through this period of monetary tightening. And you can see that the Fed has actually induced this yield inversion with their latest projections, pushing their 2023 and 24 target Fed fund rates up to 2.8%, which is actually higher than what they're projecting their longer term target to be, which is 2.4%, which actually is the lowest we've seen from the FOMC in modern history, coming down about 10 basis points from December and about 50 basis points from pre-pandemic levels. And this has huge implications on high growth. You can see ARK Innovation, Cathie Wood's, benchmark for innovation taking off over 35% in the last few days. We had QQQ here taking off 16%, and SPY, the market index, jumping just over 10%, while this harbinger of economic chaos, the 10-year yield minus the 2-year yield, kind of levels out around zero. And this is, like I said, induced by the Fed. And if our economy can stay buoyant during this period, this is a bullish sign for long-term growth stocks because of the financial modeling that lowers the denominator by 10 basis points from December, which is a huge, long-term easy money policy that is allowing the terminal value of these growth companies, specifically companies with their future cash flows being the greatest, 5 to 20 years out. That terminal value is going to be a significant driver of the valuation that these future companies can achieve. You can see the 10 and the 2-year coming real close together ever since 2022 began, and they touched, or should I say nearly touched, they were within a tenth of a basis point of each other yesterday. And you kind of saw a bounce from there. And the last time this happened was in 2019, prior to this sell-off. And as I've said, it's been a harbinger of an economic recession for a century, since the stock market began. So this is having investors concerned, but like I said, it is induced by the Fed, and the Fed has no intentions of taking our economy into a recession. The 2, the 10, the 5, and the 30, you can see the 5 breaking above the 10 going into the FOMC meeting, and then again during this week's trade officially breaking above that 30, which is the first time it's able to do that since 2006, prior to the financial crisis of 2008. And you can see ARK Innovation has just been pounded by the increasing rate expectations. But this long-term rate drop that we got from the FOMC in mid-March has caused a big bid for her oversold ETF, and it's jumping above its 50-day in the last 2 days of trading, and looks bullish if this economy can stay buoyant in the face of this monetary tightening period. Energy stocks, the shorter duration side of this equation, which equates to the short-term rates, has been inhibited as of late, not only from Chinese lockdowns being reinitiated, and China is one of the largest importers of oil in the world, but we're seeing profits being pulled across the board in this sector. We're expected to see around 250% earnings increase in this next quarter from energy, but it's going to proceed to decline from there as energy eventually, oil eventually reverts to the mean, as it always does. So we're seeing profit pulls from there and people getting into longer duration assets. Investors evacuate these shorter duration assets, such as treasuries with a 5-year maturity or less, as well as energy, which, like I said, is seeing those cash flows immediately in this upcoming quarter. And we're getting a bid in longer duration assets like Innovation, ARK Innovation ETF, Cathie Wood's benchmark for market disruption, and as well as 10 to 30-year treasuries and other fixed income interest rate driven assets such as bonds and corporate corporate fixed income. So keep an eye on that. I don't know how much short-term runway this has, but as far as long-term implications, if this trend continues with the longer-term projections of the Fed fund declining as our economy matures, I see that as a great sign for innovation in the next decade of digital renaissance. So keep an eye on that. And thanks for watching, guys. Don't forget to check out our promo at zacks.com/promo. And look forward to speaking to you guys next time.